Welcome back to the Savvy Investor Radio Show and podcast with the team at Prostatis Financial. Mike Kinnett is here. Lawrence Kiley is here. And we're talking today, of course, our favorite topic, saving you money in taxes. And that makes me think of, the old saying, there's only two things certain in life, death and taxes. Can't do a whole lot about the first one, but you can do something about the second one. And I know, Mike, when we talk about CPAs, what do? They work the numbers and they say, here's the bill, pay it.
But great historians, numbers on a page, great historians. I actually wrote a book, an Amazon bestseller, Death and Taxes, Nothing is Certain Until Now, because we know we can make some changes. And Lawrence, one of the cool things that I love about this new tax bill, the extension, is this whole SALT, right? The state and local taxes. Yes, it's attractive from the position of being able to itemize. So if your mortgage interest is enough and your charitable deductions, and by the way, they put a charitable deduction above the line, along with, remember in the old days, now Lawrence is too young, but Randy, we remember when you could deduct credit card expenses and automobile expense interest. So up to $10,000, if a car is made in the United States, you buy a car, up to $10,000 worth of interest on that car, and especially with interest rates being higher, that's an attractive thing. But at the end of the day, this whole ability to itemize is still difficult for a lot of people, especially the clients we work with, because most of them don't have mortgages anymore, right? And while they may have medical expenses, most of us hope not to have enough medical expenses to itemize in the first place. But you know what? For business owners, this is still sick. It's still incredibly sick opportunity for business owners, because most states, not all states, it's about 36 states that have enacted SALT workarounds, and that's what it's called, a SALT workaround. And 36 states have done that, and then there's another 6 states that don't have state taxes really, so that's 42. So there's only really 7 or 8 states that still force you as a business owner to pay your taxes and not be able to deduct them. And it was interesting. We were having a conversation with some clients down in Louisiana. They have a firm in Louisiana and Texas, and lots of oil revenue. And like Randy alluded to, they were working with the CPA, and we're sitting down, we're looking at their corporate tax return. They had S corporations, because that's where it comes into play the best. And we're looking at the tax returns, and we noticed that in comparison to their personal returns, they were paying obscene amount of income taxes to the state of Louisiana, because that's where they lived. And they had huge amounts of property where they were not being able to deduct all that property tax. They were not able to deduct the state taxes, their income taxes by itemizing it. It was just insane. And when we asked them, we said, well, what about the SALT workaround? I don't see that on your business return. What is your CPA doing about the SALT workaround? And they looked at us like we were idiots and said, well, what do you mean SALT workaround? And we explained it to them, and we said, well, get on the phone today and ask your CPA about the SALT workaround. And I thought Ken was going to, I thought his head was going to explode when he called me back, because I kid you not, Randy, this is what his CPA said. Oh, I guess that is a good idea. We should look into it. Now, these guys are paying, there's 2 of them that own this company. Between the 2 of them, they're paying about $150,000 a year in property and SALT taxes. $150,000 a year that their CPA says, oh, maybe that's a good idea and we should look into it. Are you effing kidding me? Maybe we should look into it. Think about this. The deduction, right? The deduction of that, it comes right off the top of the corporate return. So 140 grand. If your income is 500,000, you get to deduct 140 grand. You only pay tax on 360,000 instead of 500,000. How is that? Oh, maybe we should look into it. Maybe we should look into getting in our car, driving over to your office, and beating you with a stick. Maybe we should look into it. And so, honestly, Ken and his partner have been listening to us on our podcast for a while. So if you like what you hear, and you probably do, like and subscribe. But that's exactly what they did. They actually got on the phone and called us and said, hey, we keep hearing you talk about taxes. We keep hearing you tell us about CPAs. They're really smart and they're great historians, but maybe you're not getting the advice, the proactive advice that you want. And they had some other issues, but the easy one, right? The softball lob was, well, what about the SALT workaround? How come you're not doing that? And when their CPA said, oh, maybe we should look into that, it was wonderful, because all of a sudden, they fired the other team, hired us, and which obviously is what we're looking to do in the long haul. But honestly, if you're not working with somebody, an advisor, a tax advisor, a financial planner, whatever it is, if you're a business owner and they have not talked to you about the SALT workaround, that's insane. You just absolutely need to reach out to professionals like ourselves. You can like, subscribe. You can go to our website, thesavvyinvestorradio.com. But you have to get that professional advice, because you are leaving so much money on the table. And when I say you're leaving money on the table, that's an incorrect statement. You're giving so much money unnecessarily to Uncle Sam. And think about this. When you reduce your taxes at the federal level, you reduce your taxes at the state level. It's just insane how much money these guys are going to save and how much money you're going to save as well. Absolutely like and subscribe. We appreciate you listening.
Lawrence, if I were to walk in the office and you said to me, what do you know about salt? I would say, that's what I put on my fries. But if I said, I don't think my CPA knows what salt is either, this is not a good day. One of the things about Prostatis Financial is, the emphasis on saving you money in taxes. Nobody likes to overpay for anything. So why should we overpay taxes in retirement? I got to believe that as you sit down with people and say, we can save you money here, save you money there, everybody is so focused on getting another % in the market or another 5% in the market. This is a way that you can save money and put it literally in your pocket without having taking risk in the market.
Absolutely. And that's why it's so important to have a plan in place, where we want to have a tax plan in place, and why you want to set up the proper buckets in retirement, because you don't want to lose 20, 30, 40% off the top of your portfolio to taxes, right? If you have $1 million portfolio, on paper it's $1 million, but really it's $750,000, right? Because automatically you're losing a certain percentage to taxes. So that's why you want to have a plan in place. You want to have a tax strategy in place. You want to have those proper buckets set up, both for income, both for portfolio, tax efficient buckets. You want to have all that in place and a true plan in place that's focused on tax planning. So again, you're not losing 30, 40% of your portfolio off the top to taxes. And then again, that trickles down to your heirs as well, to where they're not paying an additional 30 to 40% in taxes on money that you've paid taxes on. So it's really important to have that tax plan in place and have taxes be a part of your investment strategy and your portfolio outlook when it comes to your retirement planning. So like and subscribe below. Let's have a conversation. Let's talk about taxes. How do we develop a tax strategy for you and implement it into your overall financial plan? So again, you're not losing 30, 40% of your overall portfolio.
Mike, when we think about tax planning, when I think about tax planning, most of it is, how am I going to help my heirs? How am I going to help my kids and my grandkids? But this is a way that you can realize some tax savings while you're retired. This has benefits for you in retirement and down the line as well.
Well, you and Lawrence are absolutely right. The amount of tax savings you can have by using the SALT workaround for business owners, let's just assume that, using Ken's example that we've been talking about earlier before, Ken is going to wipe out $140,000 worth of revenue off his tax return because he's now using the SALT workaround. Assuming between federal and state taxes that he's in the 30% tax bracket, well, all of a sudden, we're saving almost $40,000 in taxes. That's a huge tax bill. It's phenomenal the amount of money we're going to save. And so imagine if you don't need that money and you want to do legacy planning, and there's so many different opportunities for that tax deduction. You can use that tax deduction to do Roth conversions, but if you want that extra $40,000 that you've taken that you weren't going to use anyways, how about taking that $40,000 and go and buying a sick life insurance policy, right? Think about this. You could buy a huge $40,000 a year for the next 10 or 20 years. Imagine what the death benefit would be. And this is the beautiful part about it. You are literally using Uncle Sam's money, the money that Uncle Sam thought he was going to get from you. You are using that money to buy a death benefit that is tax-free for your heirs. It's absolutely sick. You are using their money to buy life insurance for somebody else. Somebody else gets it tax-free. You literally cost you nothing out of pocket. You had a choice. I'm going to send it to Uncle Sam, or I'm going to give it to my heirs, and you can multiply the number. It's absolutely sick. Tax planning, tax planning, tax planning. I don't care if you're an individual or you are a business. Tax planning matters for all of us.